Okay, good morning, ladies and gentlemen. Welcome to MACROACE with your host, Tony. I'm also the head financial analyst at FinancialJuice. Bank of Canada, we've got about 30 minutes to go through some prep, and I'll go through what to expect and what is the current sentiment surrounding the Bank of Canada and also other central banks too, and then some other sentiment of views from other investment banks and what they feel about the Bank of Canada's upcoming rate decision and what they expect in the future as well. All right, so let's get into it then. So first of all, with the reaction of the markets and kind of what to expect, usually for the currency, when the data is or when the rate is higher than expected, or if the rate is higher than expected, that is seen as bullish for the currency. Of course, if the expectations are for the central bank to get to a certain rate, and usually you don't really see a lot of movement that happens when the data comes in as expected. But a figure that is higher than expected, then that is a surprise to the markets, and then what happens is the volatility creeps in, and then you see a bullish reaction from the Canadian dollar. Unless you have a monetary policy statement that sits with it that is dovish, which could moderate how strong the initial bullish reaction could be for the currency if the central bank raises rates by a bigger amount but has a more dovish monetary policy statement. So for the stock market, very simple. Whenever you raise interest rates, again, when it's higher than expected, it's seen as bearish for the stock market and for the stock indexes, because you have the borrowing costs that are rising, and that there are obvious reasons that the central bank would present in this monetary policy statement as to why the central bank needed to raise rates or continue raising rates that the markets might not have expected. And then from that, we get is a lot of pricing in of expectations for the future of monetary policy, whether or not the central bank will continue raising rates, and then that speculation then drives stronger movements within the market. But to the surprise of, or to that statement, a little bit of a going on the other side of that, we have seen where the Bank of Canada, in particular, has raised rates also has surprised the markets, and you have seen that initial strength from the currency and the weakness from the stock market, but then that market reaction didn't last too long because of the monetary policy statement that had come out with it, and we'll go through that in a bit more detail. But usually for the stock market, when rates are raised and the rate that comes in, if it's higher than expected, is usually seen as a bearish thing. Then for the if we look at the bond market as well, very simple. Whenever rates are raised, bond yields see an appreciation in anticipation of higher rates, and of course you get a higher rate of return anyway on those bonds that you would invest in. And for the bond prices, you see a depreciation in bond prices. Again, as bond yields rise, bond prices decline. One of the reasons why that is also done is because the government has more faith in the economy, that it can handle higher rates. And in turn, what they do is they say, okay, we'll give you a higher rate of return in favor and you can buy it at a cheaper price, and you get a nice yield on top of it as well. That's one of the reasons. The other reasons is it's also market-driven, very market-driven too, with the debt market. So that's another thing to consider. It's not just the government setting yields on the bonds, but also what is the market doing, and then what can the government do to either mitigate high yields if the economy is in shambles, or provide a boost to the economy, to more government spending in the future by providing high yields with lower prices. So again, as said, with the bond market, usually bond yields see an appreciation with higher rates, and bond prices see a depreciation, and then vice versa when rates are, let's say, if the expectation isn't met in the rate or the monetary policy statement, then you can have the inverse reaction, where if the central bank was expected to raise rates but they didn't, Or let's say they kept rates as expected, but the monetary policy statement was seen as more dovish, then the bond yields could see a negative reaction instead. So there are a lot of things to consider when we're looking at interest rate decisions and how the markets can be affected overall. It's not just, the figure has been, the rates have been raised by 25 basis points, or they've maintained the rate where it is. It's also this statement that we have to be aware of, and we have to be careful of what comes through that could then shift the market sentiment in one direction. Or we could have a choppy market where the market becomes confused as to what the central bank might do with the speculative trading that could occur, and then it makes it harder to kind of pin down which way to go with your trading. So where is the economy at the moment? What is the central bank seeing? What are they looking at? So of course, CPI rose to 3.3% compared to the prior of 2.8%. The core CPI data, or the CPI trim, was at 3.6% compared to 3.7%. GDP quarter-on-quarter annualized rate for Q2 of this year was a minus 0.2% compared to Q1's 3.1%. Employment change, which we're going to be getting this Friday, and I'll also be covering a live stream on the Canadian employment change, was at minus 6.4k compared to 59.9k. Average hourly earnings, again, a key metric when looking at inflation in the economy overall. What are the pressures like? Looking at the wage pressures, was at 5% compared to 3.9%. Unemployment ticked up to 5.5 compared to 5.4. Retail sales slight tick down to 0.1% from 0.2%. PPI year on year was at minus 2.7% compared to minus 5.5%. RMPI, or Raw Material Price Index, month on month was at 3.5 compared to minus 1.5%. And the IV PMI was at 48.6 compared to 50.2. So if you're not sure of how the PMI data works in general, a figure above 50 shows expansion in that sector or that part of the economy, and a figure below 50 shows contraction. So here we see that the Canadian manufacturing sector from the IV PMI data that was released show that the manufacturing sector went into the contraction territory. And for a recession territory, usually what economists say is that you would get a figure of 47.1 or below. And then that sector of the economy is in contraction. So the previous Bank of Canada rate decision on July 12th, so they hiked by 25 basis points as expected. They said that inflation's averaged 3.7% this year compared to 3.5% in April. 2.5% in 2024 compared to 2.3% and 2.1% in 2025. And they're also concerned with the progress towards the 2% CPI target that it could stall. Potential output growth in Canada is expected to increase to about 2% per year over projection horizon from 1.4% in 2022. Then the meeting minutes that we had, which is a new thing that the Bank of Canada introduced this year, it's the same thing as the FMC meeting minutes and the ECB meeting minutes and Bank of England ones as well. So what it does, it provides information on the discussion that was had during the meeting that is held over the 2-day period but in the central bank. So what they said was that they were encouraged by the drop in CPI inflation, but core inflation measures suggest a return to 2% will take longer than previously forecast. The Governing Council felt it was too early to tell whether wage growth was easing. And then Bank of Canada views July 12th from the last rate decision. Macklem said that they're prepared to increase policy rates further. Further rate decisions will be guided by the assessment of incoming data and outlook for inflation. And Macklem reiterated that it's too early to be talking about rate cuts. July 14th, Macklem also added that he was surprised by ongoing strength in demand in the economy and the persistence of underlying inflationary pressures, according to the Globe and Mail. So whenever they say underlying inflationary pressures, you're thinking about core inflation. Okay, that's what they're referring to generally. Then the sentiment and views. So 12th of July, from that rate decision, post the rate decision, Canadian money markets see the Bank of Canada policy rate at 5.14% in December compared to 5.08% before the rate hike. Now, the numbers to you, what you can see there isn't that much of a difference, but what you need to understand is that there is the expectation that there is a pricing in of the central bank getting or sticking to 5%, sticking at 5% by December. So all it is there's just a stronger expectation of the central bank reaching that 5% range. Then August 15th, post stronger than expected CPI data. Canadian money markets saw a 35% chance of a Bank of Canada hike in September, up from 22% before the inflation data. So yes, it was stronger than expected. You did see a positive reaction from the Canadian dollar, but it wasn't enough to say, okay, the central bank is going to hike rates in the next meeting that they have. But it just means that there was a bit more pricing in of the expectation of a September hike, but not enough to tip the sentiment completely, or tip the sentiment to say, okay, they're definitely going to, or there is more than a 50% chance that they're going to hike rates at the meeting. September 1st, so post weaker than expected GDP quarter-on-quarter annualized data, Canadian money markets see a 9% chance of a Bank of Canada rate hike, down from 24% before the GDP data. So this is the key thing. So there are inflationary pressures that the central bank has to manage. Then there is also how's the economy performing as well, right? You did see what I said, if I bring it up earlier here, that they're looking at, that they'll be guided by the assessment of incoming data and the outlook for inflation. So it's not just inflation. The other part of the story and what the other part of the narrative is that they're looking at other parts of the economy too. Of course, they don't want to overdo the rate hiking cycle that they're in, or let's say have concluded. So if the economy is weaker and inflation is more or less going towards their target, if there are little bumps here and there on the way to the 2% target, then that means that there is a reason to not hike at the next meeting, unless you had data that was really strong for Canadian employment data, wage prices continued to go up. You had inflation that continued, was much stronger than expected, comparing the forecast figures and also compared to the previous figures as well. Then there would be cause for concern. But is it enough to tip the central bank to say, okay, we might need to do one more hike and then that's it? We're yet to see that. We have seen surprises from the Bank of Canada in the past where they have decided to hike rates when the central bank wasn't expected to hike rates, or hike by a bigger amount than what was previously seen or expected by the market. So a 25 basis point hike by the Bank of Canada is not off the books altogether. We have seen it where the markets have been pricing in, the central bank won't hike rates. And then just like the RBA, what they've done in the past is surprise the markets and say, we're going to hike. And we have seen that. I think in total we've seen 3 surprise rate decisions from the Bank of Canada. And when I say surprise rate decisions, I mean that it deviated from what the markets were expecting. It's not as... So what I'm saying is the Bank of Canada in their rate decision path isn't as clear-cut as it is with the Federal Reserve. The Bank of Canada is more volatile. So from that volatility, or the expecting the unexpected, there is that potential for volatility to increase, and then there are more opportunities that could be presented from the surprises that the Bank of Canada could deliver. All right, so carrying on then. So looking at the sentiment and views, so on 5th of September, you had Bank of Nova Scotia's Derek Holt said that Q2 data were skewed due to factors such as a nearly 2-week strike by 120,000 Canadian government employees and forest fires that curbed energy production. The Bank of Canada, what Holt added, said that they will want to take their time evaluating how much of a soft patch on growth is due to transitory factors versus weakening momentum. And he also added that he expects the Bank of Canada to hold interest rates steady, but reiterate that it is prepared to raise again should inflation fail to slow as forecast. And the Bank of Canada is expected to reach its inflation target by its inflation target of 2% in mid-2025. So what do we need to take away from that? We should use it as, from those comments that were made, and we'll go through some other comments too from CBIC Sheffield, but what analysts are looking at, what they're expecting, is kind of a guide of what we should expect from the rate statement itself. And in turn, if the statement itself comes out as expected, then you're not really going to see that much volatility of that bigger move. You'd expect a bigger market reaction if there were surprises or the unknown were to occur. Hey, Mickey Line. Mickey Line says, can these really move US markets? Thanks, big fellas. So yeah, there is the potential. Now, if we think about this, if the central bank decides to hike interest rates and has more concerns about inflationary pressures, it might not move the rest of the market that much or by a big amount, but the perception could change that it's not just the Bank of Canada that is changing, that is still in the tune of needing to hike interest rates, but it could change the perception that other central banks might need to do more work to bring inflation down or strong pressures within their economy. And then that might lead to a repricing of expectations of what to expect with future rate decisions. So there is a potential for that to occur. I'm not saying it is going to occur or it's a definite, but the perception change is something that we'll look at. We'll look at the S&P when we do get the rate decision, and we'll look at how the DXY performs from the rate decision and other currencies too. But that's the thing we just have to be aware of and be careful, or keep in the back of our mind that the perception could change in the markets, not entirely, but it could help that move into a different direction, into thinking the central banks might need to do more work. The pauses that are expected in upcoming meetings might not occur if one central bank is still needs to raise rates. Remember, central banks don't want to have too strong of a rate compared to other central banks, because that means their currency is if their currency is too strong in value, it means that it makes it harder to trade with that nation if the prices of the goods and services that nation has are too expensive compared to other nations that have rates that are interest rates that are weaker than theirs. So that's another thing that central banks need to balance out or need to consider as well, that if another central bank is continuing to hike rates but they're not, then that could help shift the sentiment in a different direction for the central banks. Just, you have the picture of what you see in front of you, and then you have to kind of look outside the box to see what's going on, or what could be the possible effects, and what are the ripple effects for the rest of the market. Mickey Line says, in my experience, usually Canada follows what the US does. Yeah, that's pretty true, but they didn't in this rate hiking cycle. They kind of, although yes, they did hike rates by bigger amounts, they were still, they hiked by, they did hike by bigger amounts than the Federal Reserve has done. The Fed never did a 100 base point hike in this rate hiking cycle like the Bank of Canada has done. So they're following the same direction, but they would make a judgment on how big a rate hike that they would need to do. but it doesn't mean that the Bank of Canada could then influence the Federal Reserve. But yeah, you say, but this time it's unique as Canada is announcing it first, then the US will announce later this month. Thanks a lot, guys. Yeah, so that's the cookie. That's how the cookie crumbles. You've just got to be aware of what are the central bank perceptions and what are traders' perceptions going to be like following a rate decision from one of the major central banks. Don't forget, if you like this information and you find it useful, don't forget to share it and subscribe to the channel. Get the word out there. So moving on to CIB Sheffield, spend a bit more time on Holt, but Sheffield said that by year end, it should be clear to the bank that slowing growth and additional labour market slack will, over time, bring inflation back to target. And the bank needs to let the pain from higher rates linger for a while to see that disinflation comes through. And then Sheffield also added that along with five other economists, said that they predict the Bank of Canada will begin cutting rates in the second quarter of 2024. Now, if inflation in the future data that we get and jobs data continues, if it does become weaker than what markets are expecting when you do see those figures and see the market reaction in the short term, then the pricing of rate cuts, like we've seen with the Federal Reserve expectations from markets, more or less comes closer. Or kind of cuts the timeline a little bit down from what it originally was. So if it's from July, from what this markets were expecting for the Fed, to May, for when they expect the first rate cut to be from the Federal Reserve, same thing or similar thing could happen with the Bank of Canada, where they chop up what the markets expect a rate cut maybe at the end of the first quarter rather than starting to cut rates in the second quarter of 2024. There's a possibility. It's again, it all depends on data. So let's carry on then. So let's look at the last market reaction. We've got about 8 minutes, and we also want to go through some of the deviations too. But this is the last market reaction that we had from the Bank of Canada. So this is about 5 seconds before the release came out. So you had the data was as expected. The only thing is you didn't really get a huge market reaction. It was a decent sized move. It wasn't, when I say a huge market reaction or let's say a lot of volatility, it's because one, the rate was as expected, and the statement itself was more of a repeat to a degree. Okay, with the key thing that we took away from that is the Bank of Canada remain concerned with inflation and expects a better performing economy. We've seen it with the Bank of England too, when they upgrade their expectations for the economy to do better than what they had previously expected. That can also drive the positive momentum for the currency, or the bullish reaction for the currency. Although in this case, yes, there was a more of a slightly positive news for the Canadian dollar. It wasn't really enough to go, if we're looking in the past, going back to December 2022, when he had seen on GBP CAD 77 pips down on GBP CAD. Or if we're going back to July 13th in 2022, when he had seen 99 or let's say 100 or about 100 pips down on the initial market reaction. Again, as the central bank gets closer to its rate hike, to the end of its rate hiking cycle, the market reactions also become weaker, unless there is a surprise that is presented with the rate itself, or the statement is more of a surprise. So if they are expected to say that they're going to continue the fight against inflation, it still remains a little bit high, and that they're going to, that they're ready to raise rates if needed, that's kind of expected. The unexpected stuff would be that, first of all, they take a 25 base point hike, or the other thing is that they say that inflation pressures are still too high and that we need to raise rates, rather than saying that they're prepared to raise rates. Okay, those little nuances are very very important to kind of pick up on in the rate statement itself. And some people, sometimes it's very easy to kind of gloss over them because everything looks the same. And then you kind of see the markets and you think, what do I do? Do I jump in and just follow what the market's doing, or do I, read into a bit more and then just jump into the markets? So that's a difficult thing to kind of pinpoint down, and you're initially relying on what the figure shows you. Then you're looking to the statement, and then it's the market reaction afterwards. So let's bring in the deviations then and go into a bit more detail about it. Let me get out of this here. Let me just skip to the end so you can kind of see how the market kind of reacted. So yeah, you did see some strengthening from the Canadian dollar, but it didn't really last that long. And this is after about 10 minutes. About 10 minutes of trading. So you didn't see big, huge moves. You saw the initial reaction, and then the markets were moving slowly back to what they were, markets were moving slowly in the direction that they had gone in. Okay, let me get out of this here, and let's bring in the deviations. We've got about 4 minutes, so we'll quickly want to go through the deviations here. So one of the things that we need to be aware of is that the biggest market reaction that we've seen has mainly been from GBP CAD. Okay, and then in second place you get the Euro CAD, and then CAD JPY, and then you get the dollar CAD as so you've got 1, 2, 3, 4. Okay, those are the top 4 that have the biggest market reactions, with GBP CAD leading the way, usually most of the time from what we've seen. Sometimes you might get it where it could be, the Euro, the dollar CAD or the Euro CAD that has the bigger move, but generally we've seen a bigger market reaction from GBP CAD. So this is the deviation sheet is completely free, by the way. I will share the link with you guys after I've done after we've had a look at the statement itself and see what the market reaction is like, and then we'll kind of discuss in a bit more detail. Mickey Line says, if I'm correct, today's expectation is no change, stay at 5%. Yes, that is the expectation for no change from the Bank of Canada. Lucas Adams says, only decisions, no statement. No, there will be a statement. With interest rate decisions, there's always a statement that is delivered. I think it might be, don't confuse it with the meeting minutes that are provided later, further down the line in the month of the meeting that would have happened over the last 2 days from today and tomorrow. So but we'll get the interest rate itself, and we'll also get the statement from the Bank of Canada. So that's why interest rates, usually a lot of people try and stay away from it because of the volatility that's presented and the amount of, reading and then having to understand what the central bank is saying. Understand what the central bank is saying in the statement to then be able to make an actionable trade. Kingsley said, "Can you allow copy of deviation calendar?" So in the MACROACE mailing list, when you subscribe to it, you get access to the deviations, but can't make a copy of it, I'm afraid. So it's there's a lot of demand for it. People have found it useful to understand how the markets have reacted. Yes, countdown is beginning. We've got about 30 seconds. All right, I'm going to pause, guys. I've got to focus, and I'll also try and get through the statement, try and understand what's going on with the Bank of Canada, why the markets have reacted in that way. So if the rate comes in as expected, not really expecting too much of a market reaction unless the statement is very dovish or very hawkish in either way. 10 seconds. Right. Do they deliver a surprise or not? No change as expected. Rate remains at 5%, so no change. And then you have the ISM data. Where did the ISM go? ISM services was 54.5, higher than expected. So seeing some strengthening from the Canadian dollar. So let's have a look at the rate statement itself. So with measures of core inflation still elevated, major central banks remain focused on restoring price stability. International oil prices are higher than was assumed in July monetary policy report. Okay, so that's a bit of a cause for concern that they might have to fight against the potential for rising energy prices. Not really seeing that much of a move. We did see a little bit of a move. Tightness in Canadian labour market has continued to ease gradually, but wage growth remains around 4 to 5%. Canadian economy has entered a period of weaker growth, which is needed to relieve price pressures. So that was probably, again, right, maybe was as expected. The hawkishness of energy prices was brought in, but then the dovishness of the economy entering a period of weak growth, which is needed, is kind of moderating the market reaction here. And then not really a surprise, to be honest, because of what happened with OPEC yesterday. So there is the expectation that has creeped in to the rate decision, or the rate decision market reaction itself as well, and the statement. They said they decided to keep rates at 5% given recent evidence that excess demand in the economy is easing. Okay, some more of a dovish reaction, and given lagged effects of monetary policy. All right, so not really anything out of the blue there, really. So let's do some measurements then. All right, this is a bit too choppy. Whoa, actually the dollar CAD is, let me bring up the dollar CAD, it's seeing more of a reaction compared to everyone else. Let's see here. Okay, so of course with the dollar CAD you had the ISM services data, so, and it was much higher than expected. So that's what's causing the dollar CAD, the dollar to see an appreciation there. Not really regarding the Bank of Canada decision. Right. So here's a quick measurement here. I don't think this is going to help. Let's see what's TICKSTRIKE giving us. Okay. Getting higher. Should be CAD still struggling a little bit. All right, this is probably not something we're going to want to jump. I'm not going to jump into. It's a bit too whippy. There's no clear direction here. The statement itself, although it did have more of a taken a note of what's happened recently, nothing really out of the blue. Okay, I ain't touching this. Well, of course, you guys do whatever you want to do, but yeah, I ain't touching this. All right. So, for those of you guys who wanted to get the deviations sheets and be able to have access to that, all you got to do is subscribe to the MACROACE mailing list, which I'll provide the link to here. Now, in the mailing list, what I do is I send out, once you subscribe to the mailing list, what I do is I send out an email every Monday with a brief summary of what to expect in each session in Asia, the European session and the US session, just a summary of what to expect in regards to releases, or what, with the events that are coming up, and then a summary of the weekend news, or the news leading up to the Monday, and then the link to the deviations. Again, that's completely free. You will have live access to the deviation sheet, so when you do see me updating it later on, you'll be able to see me adding in those figures here and there for the deviation sheet. So let me bring it up again so you can kind of see what I see, or you should be able to see it. So now once you've subscribed to the main list today, you won't get access. You won't be able to, I mean, you will have access to it there. It's as I said, you will have access to it straight away. Let me bring this up here. There we go. Deviations. Here we are. So we're looking at the Canadian or the Bank of Canada rate decision. That's Canadian CPI. Let me get the Bank of Canada rate decision up on here. Where are we? There we go. Okay. So there we go. As said, so with the deviations, let me just make it clearer if you're unsure of what the deviation sheet is all about and how is it useful. So this shows you how much the market reacts to economic releases. And then for interest rates, what I do is I put in the sentiment as to what would have caused a market to move in a certain way, if there's anything of importance or of note to make from the interest rate decision itself. And what I want to show you here is so this figure here in the box, hopefully you can see it there. So this initial figure here shows you the initial market reaction going to the wick of the candle. Okay, I always like to show the initial, how big was the initial market reaction, or whether it did see a bit of a whipsaw on the candle, whether it did go up and then down and then ended lower. And in the brackets here, it shows you the movement 10 minutes after the economic release has occurred and where did it end up going to the end of a candle. All on a 1 minute chart is what I use. And then a new feature actually that I'm going to be bringing out is looking at what was the market reaction 30 minutes after the economic release. So I've done that for, let's see if I did it for, yeah, I did it for CPI here as well. That is there. Okay. Yeah, so you'll be able to see that 30 minutes. You would also be able to see the market reaction 30 minutes after the release. Just a little bit of clarification. So if you do subscribe today, you wouldn't be able to get a live link to this here today. You will get it Monday in the next email. But yeah, so it is. So again, that is there showing you how much markets move, and then you can kind of make your own decision as to what to expect, or depending on what the data was like previously and how much of a deviation. Although I do kind of give my own estimations for that there myself as well, depending on, again, historically. Again, it's more of how has data caused the markets to move historically. Okay, you're not just kind of just making figures up here and there from the top of your head. Say, I expect 200k deviation to then move the market, when if the previous market reactions have only needed about a 50k deviation for non-farm payroll figures over the Canadian employment change recently. So, you know, history is very important when we're looking at how the markets could potentially react in the future. Not saying that I've got a crystal ball, or this is a crystal ball, but it's useful information to understand, which people don't, might not have access to the information or be able to see it in a. Hopefully, you guys, whoever is subscribed to the MACROACE mailing list already, to us, whoever is looking at the deviations sheet is able to see this in a nice and clear way, and it makes sense. So that's deviations, and then of course we have. Pascal, the link is pinned in the chat. It is there at the top of the chat. You should be able to see that. Now, FinancialJuice, where we get the economic release, and we also get the headlines. Let me just make this big. So FinancialJuice, again, it's where you get the live voice and text service provided to you, covering global macro news, what's going on in the markets, why the markets moved in a certain way, if there has been a headline or if there's something that you haven't seen come through. That is what FinancialJuice is all about, providing you live, real-time voice and text service. So you have your voice feed here with this button that I've just clicked on, and then you have your news feed of the text headlines that come through here as well. On the left-hand side, you have your economic calendar of the data and also for the schedule for the week ahead as well, of what to expect. So all you need is in one place: your newsfeed, your economic calendar, and your live voice and text, your live voice service as well. Now, the other thing to remember is that there are two versions of FinancialJuice. There is the Pro version and there is the Lite version. The Lite version, which is the free version, okay, has adverts that play every so often. There is a delay across the website, across the newsfeed. That's including the voice, text, and the economic calendar as well. Then there is the Pro version. Pro version has no adverts that play. It's live in real time, which is more useful to a day trader or somebody who's scalping the markets or looking for trading opportunities. And you also have access to the news desk as well, and you're able to ask questions to us the analysts, as to what's going on in the markets and why the markets might have moved in a certain way. We're not going to predict what the markets are going to do. So I think we've had a couple of those questions in the past. Somebody saying, what's the market going to do today? Or you know, of what to expect other than the scheduled events. But yeah, so that's FinancialJuice in a nutshell. Now we have a 7-day free trial of FinancialJuice Pro, but what I usually always do is get people to try out the Lite version of FinancialJuice or the free version of FinancialJuice, just so you guys can have, get a hang of how we provide our service and what to kind of expect before you say, okay, now I'm going to go to the Pro version. And so the Lite version of FinancialJuice, make sure if you do subscribe to us, if you do jump on, make sure you've once you've put in your details and you've gone to your email, you'll see an email to activate or authenticate your account. Once you've done that, go back to the FinancialJuice newsfeed, and then you should be all ready to go. Now, if you want to go to Pro, then there'll be a button here in the top left-hand side where it says FinancialJuice Pro. So it will say Go Pro, where the FinancialJuice logo is on here. Once you've clicked on that, then they'll take you to the varying subscriptions that we have on offer. And then once you've selected the subscription that you want, log out, then log back in to the FinancialJuice newsfeed, and then they'll activate Pro for you. Okay, that's something that we don't want to kind of miss out. Mickey Lyon says, is the deviation sheet available for the live version? So the deviation sheet, it's separate from FinancialJuice. MACROACE it's separate from FinancialJuice. So that's always free. And that's something that, we MACROACE, myself, provide to you guys free in an email. So whether you're Pro or you're using the Lite version of FinancialJuice, if you're subscribed to the main list on MACROACE, you'll get it. If you're not, why? I kid. Only subscribe to it if you want to. So that's FinancialJuice. Again, live, real-time voice and text service. The live version, there is a delay, but if you want to get a hang of what we do and why we, how the service runs for free, have a play with it. Get used to it before you jump in headlong. But it's up to you, whatever you're comfortable with doing. So that's FinancialJuice, and then we have TICKSTRIKE, which you can see here on the screen. Now, what does TICKSTRIKE do? So TICKSTRIKE, what it does is allows you to listen to order flow within the markets, okay, within stocks, crypto, FX, futures, ETFs and ETNs, and your internals, okay. And also, I think it did say crypto. Yeah, I said crypto too. So with the with markets, with TICKSTRIKE, another way to put it is it shows you how strong is the buying or selling momentum within the market, and it gives you a visual and audio alert of that. Okay, so this little box here, the ticker, we're putting on the GP CAD. So now the minus figure shows you the selling momentum, and the plus symbol shows you the buying momentum. The number is the sensitivity of the ticker. Now, 1 is the most sensitive to market reactions. So when there's a lot of buying and selling momentum, a little bit of buying or selling momentum that occurs, then TICKSTRIKE, that little ticker box, will give you that visual and audio alert, or either way, whichever you prefer, just the audio or just the visual. If you increase that level all the way to 15, 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling momentum that occurs will TICKSTRIKE give you an audio visual alert. So you can see here, I've put it all the way to 15. The other tickers, which are set on 1, are going off. Okay. And here on 50, the level sensitivity on 15, it's not. It's only when there's a big amount of buying or selling momentum that's going on compared to what it usually sees, then TICKSTRIKE will go off. Or I mean, if it meets criteria of TICKSTRIKE, then to go off at 15. All right. And another new feature is this lightning bolt, which somebody asked me a while ago. What does that mean? So this lightning bolt, okay, this is 15 levels below 1. So if 1 is the most sensitive to market reactions, 15 levels below that means it's super sensitive to market reactions, okay? This is a feature, particularly if you're scalping the markets, then this is something, again, to add to Arsenal. So if I just put it, so at the moment, so I've got the lightning bolt on, and it's at 15. So consider that, let's say that's 1, okay? And if we pull that all the way down to 1, you can see that there is more sensitive. It's really sensitive. So you can see that here. As it's kind of changing, you can kind of match it up really. You see that a little bit buying, a little bit of selling. Then TICKSTRIKE will kind of pop off here for you then. So if you're scalping the markets, then that, of course, you can kind of chop and change at whatever level works for you. All it does, it gives you more sensitivity. So you get more of a real-time market movements being presented in a TICKSTRIKE here for you. Jeez, this is nuts. But if that's what you prefer, then that is there for you. So I'm going to take that off. That's a bit too much for me. It doesn't work for me. But it can work for someone else, depending on your trading style, particularly if you're scalping the markets. That is there for you to play with. So there's also a 7-day free trial of TICKSTRIKE here in the chat. That is there. Nicky Line says, just subscribe, really send through the email. Thanks for great work. Yes, so Monday you'll get the email with the deviations for you to be able to have a look at. And then it'll be yours forever. It's completely free. All right. Let's have a little look here. Okay. And then finally, so if you like trading high probability stocks, futures, FX, and crypto breakouts in real time, then you can you can join up with us and subscribe to Unusual Activity. So there we go. That is there for you. That is a link there. Now, that concludes today's live stream. Yeah, this is not a nice, not really getting a lot of movements here. Okay, yeah, so Friday I'll be doing Canadian employment change, which is the Canadian version of non-farm payrolls. Let me get the live stream link for you there so you don't have to trawl through it. I'll try and find it anywhere. Get it up on here. Also, yeah, it's nice. We've gone past 4,000 subscribers, so thank you to all you guys who have joined in or on the regular, or if you're new to the channel, or if you're new to us, again, thank you for your support. Let's keep going and get the momentum pumping even more. I'm just gonna get it here. Here we are. Right. Okay. That's the live link. Well, that's the live stream for tomorrow. With it there. Okay. All right. I will thank you very much for joining me live. Everyone take care. I will see you Friday for Canadian employment change. Right. Bye now.